You have spent decades building your fortune. You have survived the booms and endured the busts. The game of accumulation is nearly complete. But now begins a new and more perilous game, the game of preservation. In youth, time is an ally, a forgiving force that allows for the recovery from mistakes. In the late stages of a career, a single catastrophic error can be final. There is no second chance. No man in modern history has understood this asymmetry of risk better than Charlie Munger, the intellectual architect behind one of the world's greatest financial empires. His wisdom is not a guide on how to get rich. It is a masterclass on how to avoid becoming poor after you have already won. It is a philosophy of defense, of prudence, and of recognizing that in the final innings, the surest path to victory is to simply not lose. The cornerstone of this entire philosophy, the single mental model Munger has urged above all others, is a simple directive. Invert, always invert. This is not a clever turn of phrase, it is a profound method of thinking. The average man approaches a problem by asking, how can I achieve success? He maps out a direct path to his goal, focusing on the positive steps required. The Munger method flips this entirely. It begins by asking, what can cause my utter and complete ruin, and how can I avoid it? Instead of studying success, you first study failure. You identify all the potential pitfalls, all the foolish errors, all the catastrophic risks that could lead to disaster, and you assiduously construct your strategy to avoid them. For the late career investor, this mental shift is not just useful, it is essential. The objective is no longer the aggressive pursuit of growth. The objective becomes, in Munger's plain-spoken terms, the avoidance of stupidity. Instead of seeking the next stock that might multiply tenfold, the primary task becomes identifying and ruthlessly avoiding the investment that could fall by 80%. It is the art of playing a winning game by simply not playing a losing one. The annals of Wall Street are a testament to the genius of men who mastered the game of accumulation, but who ultimately met their ruin because they could not invert their thinking to see the abyss that awaited them. Consider the spectacular career of James R. Keene. A man of meteoric rise, he amassed a fortune of $13 million, a kingly sum in his day, first by mastering the speculative currents of the California mining boom, and then by correctly anticipating the great bull market that followed the resumption of specie payments in the late 1870s. In the arena of making money, he was a genius, a force of nature. But Keene, in his triumph, could only think offensively. His mind was fixed on the next conquest, the next great coup. He could not bring himself to invert, to ask, what is the single action that could destroy all that I have built? Had he done so, the answer would have been obvious, extending his lines into a field beyond his expertise. Flushed with victory, he plunged into markets he did not understand, attempting to corner wheat and other commodities. He applied the same aggressive all-in tactics that had served him in the volatile mining market to the vast, complex world of global agriculture. It was a fatal error. The very week his famous racehorse won the Grand Prix in Paris, Keene himself was utterly broken by the steady, unyielding supply of wheat from the western farms. He lost nearly his entire fortune. He had been a master of finding a path to success, but he had given no thought to identifying the path to ruin. And it was that path he ultimately walked. The late career investor must learn from this. Your greatest risk is not missing the next bull market. It is being caught in a speculative venture that you do not understand and cannot survive. This leads to the second core principle, a truth that governs the markets far more than any mathematical formula. Temperament is more important than IQ. A man with a genius-level intellect who is prone to panic is destined for failure. A man of average intelligence who possesses emotional fortitude and patience has every chance of success. The market is a psychological battlefield, and in the long run, victory goes not to the swiftest of mind, but to the steadiest of nerve. This is supremely important for the investor who can no longer afford a catastrophic loss. He faces a dual psychological assault. From one side, he feels the fear of missing out, watching younger, more reckless speculators chase fashionable stocks to absurd heights, and he feels the pull to join in lest he be left behind. From the other side, during the inevitable market downturns, he is gripped by a special kind of terror as he watches the nominal value of his life savings shrink day by day. The temptation to sell everything, to flee to the false safety of cash at the very bottom of a panic, can be overwhelming. The ability to resist these two powerful, irrational impulses is the essence of a successful investment temperament. It is the ability to remain calm, objective, and rational when the entire world around you has gone mad. The great panics are the ultimate test of this quality. During the crisis of 1907, a contagion of distrust spread from Wall Street's core, closing banks and trust companies. On the floor of the stock exchange, a heavy and prolonged decline was met with a continuous flood of liquidation. Even the most astute men were swept up in the hysteria. During the Black Friday gold panic of 1869, the gold room was described as bedlam let loose, a scene of wild excitement and consternation, where fortunes were lost in minutes. In these moments, intelligence counts for little. The market becomes a primal arena of fear. Yet, it was precisely in these moments that the old veterans did their best work. Their strength was not in predicting the panic, but in their temperament during it. Their ability to remain calm, to see the panic not as a threat, but as the opportunity they had been patiently waiting for, was their greatest asset. They were not smarter than everyone else, but they were more emotionally disciplined. They had mastered themselves, and therefore, they could master the market. The late career investor must strive for this same stoicism. He must cultivate the emotional resilience to watch his portfolio decline without panicking, and to watch a speculative bubble inflate without being tempted to join the frenzy. His success will depend not on what his brain knows, but on how his nerves behave. Once the defensive mindset is established as the bedrock of your philosophy, the art of inverting a problem to first avoid the paths to ruin, the next crucial stage is the construction of an analytical fortress. It is not enough to simply avoid stupidity. One must have a rigorous framework for identifying the rare opportunities that are truly worth one's capital. This is not a process of chasing market fads or complex theories. It is a return to fundamental business principles, a method of analysis that is as potent today as it was a century ago. It requires a clear-eyed assessment of quality, a disciplined patience for price, and an unwavering commitment to simplicity. This analytical journey begins with the third Munger principle, an ironclad rule that serves as the first great filter for all potential investments. Stay within your circle of competence. This is more than just a casual suggestion. For Munger, it is a moral and intellectual imperative. If you are not capable of explaining a company's business model, its competitive advantages, and its primary risks to an intelligent layman better than any analyst on Wall Street, you have no business owning its stock. The size of this circle is irrelevant. What is absolutely critical is that you know its precise boundaries and never, under the influence of greed or popular enthusiasm, venture beyond them. For the late career investor, this principle is a shield against the most seductive and destructive of temptations. As one's career progresses, there is a natural pull to diversify into trendy, exciting, but ultimately complex sectors: biotechnology, esoteric software, speculative new technologies. The allure is powerful, a promise of recapturing the explosive growth of one's youth. But it is a siren's call. It is infinitely better to own 3 businesses you understand with the certainty of a proprietor than it is to own 30 companies about which you have only a superficial second-hand knowledge. In the first case, you are an investor. In the second, you are a collector of lottery tickets. The history of Wall Street is replete with cautionary tales of men who strayed from their circle of competence. The speculative career of Henry Villard and his infamous blind pool in the Northern Pacific Railroad serves as a timeless object lesson. Villard, a man of immense charisma and persuasive power, raised an initial fund of $8 million from a host of otherwise solid and intelligent men. His purpose was to acquire control of the Northern Pacific, but the details were kept shrouded in mystery. The investors were not buying a business they understood. They were betting on a man. Flushed with initial success and the power of his own narrative, Villard soon exhausted the initial funds and returned to his subscribers, proposing to extend the scope of the pool's operations and calling for another $12 million, which he successfully raised. The subscribers were investing blind, driven by the fear of missing out on a grand enterprise, the details of which they could not comprehend. The result inevitably was a grand collapse. The $20 million miscalculation in the road's completion cost, the sudden embarrassment and the ultimate failure of the scheme were the direct consequences of investors placing their capital far outside the boundaries of their knowledge. They were victims not of fraud in the legal sense, but of their own intellectual abdication. They had outsourced their thinking, and for that they paid the ultimate price. Once you have defined the industries you are competent to analyze, the fourth principle dictates what you must look for within that circle. Demand a wide and durable economic moat. An enterprise that operates in a brutally competitive field, no matter how well managed, is a fragile vessel. A truly superior business is a fortress, protected from the relentless siege of competition. This protection, this economic moat, is the source of all long-term above-average returns. For the investor focused on capital preservation, the moat cannot be shallow or temporary. It must be deep, wide, and enduring, likely to be just as effective in 20 years as it is today. Munger seeks businesses that are almost impossible to kill, enterprises whose fundamental competitive advantages are so powerful that they can withstand incompetent management, economic downturns, and the ceaseless march of technological change. History provides powerful examples of such enduring fortresses. Consider the financial empire of the Rothschilds. Their moat was not merely their immense capital, though that was formidable. Their true, unbreachable defense was a multi-layered system of competitive advantages that no rival could replicate. They built a global information network using carrier pigeons and private couriers to get news of battles like Waterloo hours or even days before their competitors. They cultivated an unparalleled reputation for integrity and sagacity, making them the bankers of choice for the kings and princes of Europe. And most uniquely, their founder, old Anselm Rothschild, decreed that his 5 sons, stationed in the 5 great capitals of Europe, should constitute but one firm, sharing all profits equally and never dividing the family fortune. This structure, bound by the powerful ties of family and religion, created a unified financial entity that could act with a speed, secrecy, and scale that was simply impossible for their rivals. Theirs was not a temporary advantage. It was a dynasty, a moat built over generations that has endured for centuries. Charlie Munger is renowned for his concept of building a latticework of mental models from various disciplines to make better decisions. But what if one of the most powerful models is history itself? What if you could step into the minds of men who faced the same dilemmas of fear, greed, and uncertainty that you face today? The new, complete 2-volume edition of 50 Years in Wall Street is not a mere collection of stories. It is a 1,000-page case study in the unchanging models of human behavior in finance. The original, unabridged text by Henry Clews, complete with all its photographs, transports you to the era when the foundations of the modern economy were laid. You will see moats being built and moats being destroyed, witness the effect of manipulation and panic on prices, and discover how only the most disciplined survived. It is a historical mental model that will train you to recognize the patterns that repeat from one generation to the next. For any investor seeking a deeper understanding of the markets, this guide is indispensable. The link is in the description. Having identified a wonderful business with a durable moat that lies within your circle of competence, you are faced with the final and most difficult discipline of all. It is Munger's 5th principle, the one that requires the most strength of character. Be patient. Wait for the fat pitch. This is what Munger famously calls the sit-on-your-ass school of investing. The great misconception about investing is that it is a field of constant action. The reality for the true master is that it is a pursuit characterized by long periods of intense study and almost total inactivity, punctuated by rare and brief moments of decisive action. The world is not full of thousands of wonderful opportunities. They are few and far between. The task of the investor is to do the difficult analytical work to identify the great businesses, calculate their intrinsic value, and then have the supreme patience to wait until the market, in its folly, offers one of them at a price that represents a clear and obvious bargain. For the late career investor, this principle is the key to preservation. You have no need to swing at every pitch. Your capital is already substantial. Your goal is not to capture every minor market updraft. Your goal is to avoid the ruinous error of overpaying for an asset and to wait for the rare, no-risk opportunity to deploy a significant amount of capital when the odds are overwhelmingly in your favor. This means you may go for a year or even longer without making a single purchase. It requires the fortitude to watch the market run away from you, to see others celebrate their paper profits on speculative fads, and to do absolutely nothing. This inactivity is not laziness, it is the highest form of discipline. It stands in stark contrast to the feverish activity of the ordinary speculator. The average operator feels the need to be constantly in the game, to have a position, to be moving. As Clews observed, they change their holdings from day to day, with no advantage except to their broker, and their monthly statement shows a heavy list of charges for interest and commissions with no offset of profits. They are addicted to the action, and this addiction is their undoing. The old veterans of the street, by contrast, were masters of inactivity. They were not seen in the brokerage offices every day. They could let years go by, patiently allowing their cash reserves to build. They were waiting for the squall, the panic, the moment of universal fear that would deliver the world's finest assets to them at bargain prices. They understood that in investing, as in a lion's hunt, success is determined not by constant motion, but by an enormous reserve of patience followed by a swift, decisive, and powerful strike when the perfect opportunity presents itself. For the investor who has already won the game, this discipline of patience is the surest way to keep what he has earned. Having cultivated the defensive mindset and built the analytical fortress necessary to identify quality, the final stage in the Munger philosophy is the philosophy of action. It is one thing to know what to do. It is another entirely to have the discipline to do it correctly and the wisdom to know when to do nothing at all. This is where the long-term preservation of wealth is either secured or squandered. It is a framework built on concentration, relentless intellectual honesty, and a commitment to lifelong learning, ensuring that the capital you have so diligently built is not only protected, but continues to grow safely and rationally. This philosophy of action begins with a principle that stands in direct opposition to the conventional wisdom taught in every business school. The sixth principle: make a few big bets when the odds are overwhelmingly in your favor. Munger has famously expressed his disdain for what he calls diversification, the practice of spreading one's capital across dozens or even hundreds of different stocks in the name of safety. He argues, quite correctly, that for the investor who truly knows what he is doing, this practice is a guarantee of nothing more than mediocrity. The idea that owning a tiny piece of 50 different companies, many of which you barely understand, is safer than owning a substantial piece of 5 companies you have studied exhaustively and know inside and out is an absurdity. The safety, Munger insists, is not in the quantity of your holdings, but in the quality of your knowledge and the quality of the businesses you own. For the late career investor, this principle is liberating. The frantic pursuit of aggressive growth is over. You are no longer required to find the next speculative rocket ship. Your task is to concentrate your capital in a select portfolio of 8 to 15 supremely high-quality, deeply understood enterprises that you have purchased at a reasonable price. This, paradoxically, is the safest strategy of all. When you own 100 different companies, you cannot possibly keep track of them. You are a passive observer, a victim of the market's whims. When you own 10, you are a proprietor. You can follow each company with the intensity and focus of a true owner. You can read every report, listen to every conference call, and understand the competitive landscape intimately. You are concentrating not just your capital, but your intellectual energy. The risk is reduced because your knowledge is increased. This is the ultimate defense. A portfolio built not on a flimsy foundation of diversification, but on a bedrock of concentrated high-quality businesses that you know as well as you know your own. Yet, even with the most carefully selected portfolio, the world does not stand still. This brings us to the seventh principle, one of the most difficult but vital disciplines for any investor, especially one for whom a major error could be final. Be prepared to destroy your best-loved ideas. This is the principle of radical intellectual honesty. Munger is famous for constantly trying to break his own investment theses. He does not seek out information that confirms his beliefs. He actively and relentlessly seeks out evidence that proves him wrong. He understands that the human mind is prone to what he calls confirmation bias, the tendency to favor information that supports our existing opinions. This is a fatal flaw for an investor. It is a vital discipline for the late career investor because you cannot afford to fall in love with a stock. You may have owned a company for 20 years. It may have been the source of a great deal of your wealth. But if the fundamental facts of the business change, if its economic moat begins to narrow, if its management becomes incompetent or dishonest, if a new technology arises that threatens its very existence, you must be willing and able to recognize this change, admit your initial thesis is now invalid, and sell. Your ego is the greatest enemy of your capital. The refusal to admit a mistake, the tendency to hold on and hope for a recovery in a deteriorating business is the fast track to permanent capital loss. The world is dynamic. Great companies can become mediocre, and mediocre companies can go bankrupt. Your loyalty must be to reality, not to your past decisions. History provides a brutal lesson on this point. Think of the investors at the turn of the 20th century who held steadfastly to their portfolios of canal companies and horse-drawn carriage manufacturers. They owned the dominant businesses of their day, enterprises with seemingly unbreachable moats. But a new technology, the railroad, was emerging. Those who recognized this monumental shift and adapted their portfolios survived and prospered. Those who clung to their old cherished ideas, who refused to destroy their own thesis about the permanence of the canal boat, were ruined. A generation later, the same story repeated itself. The investors who were convinced of the eternal dominance of the railroad were, in turn, disrupted by the rise of the automobile and the airplane. The world is relentlessly forward-looking. A portfolio built for capital preservation must be the same. Intellectual honesty, the willingness to look at the facts with clear eyes and destroy your own most beloved ideas when they are no longer valid, is not just a virtue, it is a survival mechanism. This leads us to the final two principles, which are not so much rules as they are a single, all-encompassing philosophy of life, the engine that powers this entire intellectual machine. Be a lifelong learner and understand the misjudgments of human psychology. To remain successful in a changing world, one must be in a constant state of learning. Munger's own intellectual appetite is legendary. He does not confine his reading to business and finance. He studies psychology, history, physics, biology, and literature, seeking to build what he calls a latticework of mental models, a collection of concepts from various disciplines that allows him to see the world as it truly is, in all its interconnected complexity. He understands that a man with only one model, like a carpenter with only a hammer, sees every problem as a nail. The world is too complex for such a simplistic approach. Of all these disciplines, the most important for an investor is the study of human psychology, specifically the catalogue of cognitive biases that cause intelligent people to make irrational decisions. These are the powerful subconscious forces that drive market manias and panics, the herd instinct that makes us want to buy when everyone else is buying, the confirmation bias that makes us seek out information that validates our existing beliefs, the overconfidence bias that leads us to overestimate our own predictive abilities, the loss aversion that makes the pain of a loss feel twice as intense as the pleasure of an equal gain, causing us to sell at the worst possible moment. By understanding these biases, you can begin to recognize them in your own thinking and guard against their influence. And even more powerfully, you can recognize them in the behavior of the market as a whole. You will understand that a market bubble is not a financial phenomenon, but a psychological one, driven by social proof and envy. You will understand that a panic is driven not by fundamentals, but by the raw, contagious power of fear. This understanding provides the ultimate analytical edge. This commitment to perpetual education is the thread that connects all great masters of the street. Henry Clews, writing decades before the formal study of behavioral finance, insisted that the business of Wall Street requires long and close training in financial affairs. The true investor never stops being a student. He understands that his greatest asset is not his capital, but his continuously expanding knowledge of how businesses, markets, and human minds actually work. In the final analysis, Charlie Munger's philosophy for the late career investor is not about complex financial models or daring speculative ventures. It is about a simple yet profound wisdom. It is about playing a defensive game. It is about avoiding mistakes rather than chasing genius. It is about being patient, disciplined, and relentlessly rational. It is a defensive strategy designed to preserve the fortune you have worked a lifetime to build and to allow it to grow safely and securely, shielded from the psychological storms and analytical errors that bring ruin to so many. It is the ultimate testament to the idea that in the world of investing, the greatest strength lies not in what you do, but in what you steadfastly refuse to do.